Okay, welcome back all. So this next session looks at research into implementing AASB 16 leases, the investor and preparer perspectives. So this research has been conducted by Professor Michael DeVerne, Nicole Giles and Tom Frick at the University of Melbourne and Associate Professor Dean Hamlin of Monash University. So Michael, the stage is yours.
Thanks, Tom. If we can start with the first slide. We will get into talking about leases, which has been something that has been a topic of debate for a long, long time, as I'm constantly reminded by my colleague who, if we're in the office, is right below me, a floor below me, Kevin Stevenson, who says we haven't been able to get this right for so long. So let's see where the debate has got us to, and what's happened now. We seem to be properly recognising leases, and we're going to take both the investor and preparer perspectives on this. And I do have to thank our research assistants on this, Tom Frick and Fakan Shah, and also CPA Australia, who has been funder of this project. So next slide, please. So this has been a long debate about lease accounting, and I remember many years ago learning the difference between operating and financing leases and the big issues that were involved with that and the debate that occurred there. And we see some very different and competing perspectives still persisting. So Warren McGregor making the lovely comment that the demonstrable failure of the existing model to reflect the economic effect of leasing transactions on the financial statement of leases. So we have a problem. We're not capturing everything that's going on, but there's also some real resistance to change, and there's been real resistance given how long it's taken us to get there, given that the initial ideas of some of what we now have were around right back in the 1970s. And one of our investors that we spoke to, as you'll see, we spoke to investors and we surveyed preparers, expressed this quite succinctly, that the threshold for changing a standard should be extremely high because of how much it affects comparability. And that's a valid point, but it also is a short-term view, and we'll see where the mix of things come out as we go through. But to sort of give a hint, on the whole, it seems to be a fairly positive response to AASB 16, with still some reservations, but we think they'll disappear through the transition. The challenging task that the AASB has had with this was developing a working model. And I think the key part here is convincing the constituents that a major overhaul was warranted. And we've managed to do that. We've gone through the implementation. We're still in that transition stage, and there's still a lot of issues that are coming to the fore. And what those challenges are, I think, will change over time. So what we're providing today is very much a snapshot around that implementation period. And that implementation period is an interesting one because it's where you see a lot of the change, but it's not going to identify clearly what the longer term implications of this might be and what we get to when we get to a more of an equilibrium position in the marketplace. So next slide, please. So in terms of giving a perspective on our approach, we wanted to look at both preparers and investors. We'd previously done some work looking at the new introduction of the revenue standard, AASB 15, and we'd done a preparer type view on that, surveying preparers. And we realized when we did that, the really missing story was what was investors' response to that. And so in this setup, we've done both preparers and investors. And so in terms of what we got from preparers, we were looking at trying to understand what got in the way, what were the challenges, where was all the effort and pain points in implementing AASB 16. And what we're interested in here is trying to understand that implementation process, help those firms understand where they are in the progress on implementing the standard, because one of the things that we saw in the work we did with 15 was if you give people an extension on when a standard is implemented, they will take up the slack of that extension and still be running behind. We see a little bit rosier picture with 16, but maybe that was partly coming off the shock of the implementation of 15 that have driven that. But obviously, this is also about informing the post-implementation reviews that the standard setters are involved in. So the way we went about this was we did a survey of 140 CPA and CA qualified professionals who were involved in the implementation of AASB 16, and this was right in the midst of that implementation prior to reporting going out in a substantive way. So this was June, July last year. And so we wanted to get them at that stage of the process where they were wrestling with all the issues of the judgments that were involved, what data they needed, what were the issues and challenges in bringing this to the fore. Because one of the things we've noticed in the academic literature, at least, is there's not a lot of studies done on the actual implementation process. You see a lot of before and after type things, but the internal challenges that preparers go through in trying to comply and implementation is something that is been largely overlooked, and we're trying to address that a little bit. Of course, we're ultimately doing this for investors, so then we sorry. This is what happens when you have too much technology. I've bumped a mute button. Thank you, Dean, for letting me know. So just start again with investors. So we're looking at investors and the costs, benefits, and challenges in interpreting the financial statements that are prepared under AASB 16. So it changes a lot of the information they're seeing. Is it reaching those benefits that were claimed by the AASB and AASB in the implementation? Because if we can't see the benefits for the investors, then we have a significant problem that we're dealing with. And for getting into that sort of detail also helps us in guiding the disclosure choices and informing, again, the post-implementation reviews, but it also gets a better understanding of investor decision-making more broadly, so we can understand as we look to future standards what are going to be the perspectives and ways in which we think about providing the best way of presenting and recognising things in the financial statements, given the way that the investors are approaching and making those decisions. And we've done some prior work that we presented a couple of years ago at the AASB Research Forum on the usefulness of decision usefulness of financial statements that also gave us some of that insight. And we're seeing some of those issues recur in what we saw here with the investors that we interviewed. And so we interviewed a bunch of professional investors and analysts. We did this around April, June this year. And just to give you a sense of how much that generates, about 20,000 words of transcripts. So a lot of stuff that we have to go back and try and extract some themes and ideas about. Next slide, please. So as I said, when we did a similar survey study within AASB 15, we saw that there was a lot of firms that took advantage of the extension and were late in the implementation. We see a bit rosier picture here with what we're seeing with the 140 people that we surveyed for the implementation of AASB 16. Just some broad range of industries that we had covered, and tended to be some large, but we also had some small. So you can see we had a good mix of firms. We did try to see whether there was any differences between size of firms and industries, but there was nothing that was particularly jumping out in that regard. But as you can see from the chart at the bottom there, a good chunk were completed or near completion. Remember, this is June, July last year. The majority were in progress and well advanced in that progress. There was a surprising number who were still sort of only at the early stages or hadn't started. And some of that may have been an issue of their exposure to leases and where they were at. And so also could have been when their year ends impacted as well. So some issues that came through there. But in general, we're seeing a little bit better performance here in terms of getting up to speed on the implementation comparatively to what we saw with 15. I think 15 was a bit of a scary experience for everybody. And 16 is also much more narrow in its focus rather than impacting the organisation so broadly as what 15 did. So it was also easier to implement in that respect. Next slide, please. So one of the things we were really interested in was trying to understand what were the key challenges that were occurring for those. And we want to contrast here those who were, advanced stages or had completed versus those who were at early stages. And so it sort of gives you a good indication of, what they found when they started versus what they were expecting to find. And identification of leases is a really interesting one because, those who hadn't started didn't see that as a big problem. Those who had started, that's what they saw as the major challenge that they were dealing with. Now, this may have been a reverse causality thing that those who knew it was going to be a big challenge started earlier, but it is an interesting thing that suggests that having a good handle on what you expect is going to be the challenge and what is realised as the challenge becomes a really important issue when we look at this. We looked at some of the key judgments that were involved: determination of discount rates, determination of lease terms, impairments, incentives, and deferred tax. Not a lot of variability there, although except for the determination of the discount rates. Impairments we'll come back to. I think impairments are much more likely to be a future challenge than a current challenge that we're dealing with. The one that I really want to focus on is the identification of leases. And we'll see this when we get to thinking about the data and the availability of data to be able to implement this standard. It was pretty clear from the surveys that firms did not have a good enterprise-wide register of lease contracts available. And in talking to preparers anecdotally as well, we saw some evidence of this, that the firms may have had the data, just may not have been in a central finance function that they could access that data. So identifying what lease contracts they had becomes really problematic. And one of the questions that then raises is, if I'm meeting the disclosure requirements in a pre-AASB 16 world, how am I doing that if I don't have a good handle on what leases that I've got in the first place? And so that recognition versus disclosure requirement actually changes the nature of the attention that I'm giving to this issue as a firm. And so I think there's a really interesting broader question here as we move and make the debate between recognition and disclosure, because that recognition has motivated them to go and find and centralize a lot more of that information. And it was quite surprising to see that they apparently didn't have good data about all the leases they had in the firm, easily accessible in a central repository. Disappointingly so. We saw the same thing with sales contracts with the implementation of the revenue standard, but sales contracts make a little bit more sense to have a lot more diversity and hard to keep track of. Lease registers, I would have thought, would have been a little bit stronger in this, but that's not necessarily been the case. We did have a number of respondents indicate that they were relying on the low asset and short-term lease exemptions. So about 30% of our respondents were highly reliant on that. Next slide, please. So here again, we see that same story when we look at what's going on in transition versus longer term. And things even out in the longer term is the expectation. But in that transition stage, there's a lot of work being done in establishing procedures, systems, and technology, and in data gathering. And we actually asked them, what software tools are you using? And out of the 140 respondents, we only saw the same software tool come up at most about 3 or 4 times. So there wasn't a ubiquitous software tool that was being made available to do that, the market failing there. But there's a lot of data gathering and systems that need to be put in place, both to implement the standard, but also in the ongoing effort. And that just reinforces the whole issue that how do you make judgments under pre-AASB 16 world if you don't have a good sense of what all the lease contracts and commitments you've got in the first place are. And so this data gathering issue is something, again, we saw the same thing with the revenue standard when we did the earlier survey a couple of years ago on the implementation of that. Firms don't seem to have good enough data underlying their systems to be able to make the sort of judgments. And so the standards are driving them to improve their data and improve their data management, as well as what they're actually reporting on. So there's some indirect benefits that come from doing that. Next slide, please. So what about the benefits from a preparer perspective? And there is a caveat here that preparers are obviously going to be biased against saying that the claim benefits are achieved, particularly at this point in time, because in the throes of the implementation, they're bearing all the costs. They did in general agree that comparability and transparency was going to be improved. They were less convinced about the need for non-GAAP information, and non-GAAP information is something that there's a really interesting story about we'll come back to when we get to the investor perspective. We asked them also about faithful representation of assets and liabilities, and they were largely ambivalent. And this was an interesting one. I have a bit of a fascination with the concept of faithful representation, and I think it highlights that there's not a lot of understanding what faithful representation really means because it can't be readily implemented in a rule-based sort of way, which I think is part of the reason for having faithful representation over reliability as a concept. So the ambivalence there is more of a quirk rather than a substantive issue of whether the benefit is realised or not. So if we move to the next slide, and start to recognise too that there are some operational benefits here for the implementation of AASB 16. So it has real economic effects. Standard setting and standards are not just about changing what we're reporting, they actually change what's happening in the business. And it's not just in terms of what the investor reactions are to that or changing their cost of capital because they've got better transparency and comparability. What we're seeing here is evidence of better management of leases, and that goes back to having to collate the data. So they've now got a whole of organisation view of the lease contracts. It's also leading some of them to think about moving to more service-based or renegotiating some of their debt contracts. So the changes are substantive changes that they're making in their business as a result of this, and considering alternative financial arrangements. But the one that topped out here, which I think is really interesting, is better management of leases. And so one of the benefits that I think standard setters really need to be aware of here is that by pushing increased disclosure and recognition requirements, you're actually pushing back on the data that these organizations have to then manage and how well they manage that data, which then leads them to manage the underlying asset or liability much more effectively because they've got better data about it. And so it's this regulatory push. Now, I've asked preparers about this anecdotally, and they never see this much when they're in the throes of implementing it. They don't recognise that opportunity as strongly. I actually think some of these projects, and we certainly saw this with 15, was an opportunity for getting through a lot of technology projects on the basis of I've got to have better data to be able to comply effectively. And that's where the lead time in standards can be useful in that regard. But this better management is a key factor that gets to a real impact on the organisation of the standard, not just on what's happening in the capital markets. Next slide, and we'll start to think about what happens then from those capital markets and the investor perspective. And we got some mixed views, and they tended to be fairly strong views when they were negative views. So things like absolutely no impact, whereas the majority were probably more of the line of a significant impact on all investors. It was very clear, and we weren't surprised, that impact was industry and firm specific. It depends on how much you're relying on leased assets. So retail and aviation are very much going to be hit by this, and you could see that even prior to the standard coming to play with who was doing the large amount of lobbying around the implementation of this standard and what it was going to look like because of how much it would affect them. And then, of course, then the firm's exposure to long versus short-term leases. And sort of on the understanding that more broadly is that one of our investors commented there's a strong appreciation that in an economic sense, things aren't changing about these businesses, but the way that we analyse these businesses is being significantly impacted by the standard. So from the investor perspective, they're not seeing the substantive change. What we saw on the preparer side is that in the longer run, there actually are some substantive changes because they're better managing their leases and they're getting better data about that. But the investors aren't going to see that yet. And they do recognise that the economic substance hasn't changed and how you then backtrack and adjust for that accordingly. Next slide, please. So there's a bit of a debate then on this recognition versus disclosure. And I think that's a bigger issue in general that we need to think about. in a range of different settings. And this has been an ongoing debate in the leasing setting for a long time. I love the quote from one of our investors that we interviewed. It said, "A solution for a problem the investment market didn't have." Now, this was clearly one of our very big lease skeptics. They did not think the AASB 16 was worth it. And there was a lot of effort for not much gain. That probably wasn't the widespread view, but there were some significant views on that. The investors did recognise that on the foresight that it would help improve things for firms that were doing the right thing in terms of better transparency and comparability and how that might impact cost of capital. It made things a lot fairer for those who were leasing versus owning and creating comparability there. And in general, it's been a net positive. And we start to see some of the tricks or skullduggery, as one investor said, about issues like a private equity company doing sale and leaseback transactions immediately prior to an IPO to try and pump things up. So it is removing some of the market tricks that players can play. So investors are seeing that as a positive. On the more skeptical side, were those who said, look, it's not making an economic substance difference, so as long as we've got a disclosure, I don't care. And we'll just adjust to it, but it doesn't really matter. And it's just that the numbers are now better disclosed, not really that there's any economic substance that has changed. It's not that they're more geared in any way, shape or form. But I think the key element on that against argument there is it's just that the numbers are now better disclosed. And so recognition actually changes the quality of the disclosure, which is a theme that we're seeing going on here. And the concluding remark that I think just captures this is if we fast forward 40 years from now and we're seeing AASB Research Forum, they're going to look back historically and say, what were they debating about? They're going to wonder about this debate that we're having today because it's for this investor, it was a non-issue. We should have had recognition of leases in the 1970s, which I know would make someone like Kevin Stevenson very happy. Next slide, please. Change is never easy, and certainly that was one of the things that the investors did highlight, that there were some costs to them in this change. A lot of those costs are short-term, but they are significant. So historical comparability is really hurt, and that really hurts you if you're investing over a long period of time to be able to understand what the trends are and do those that comparability. And to some extent, we even come across some investors who said, look, what we're doing is we're using the fact that they're having disclosed things in transition so we can still use the same approach that we've used before. But once they drop that transitional information, then we're going to have to reinvent our models and everything like that. And we're not looking forward to that. So they're even fixated on the historical way that we're doing things rather than trying to adapt quickly to this change. And so that comparability, it's a short-term cost. But it is nonetheless a shock to the marketplace in that regard. The interesting way that was often expressed was really about the burden that it places on investors because of the complexity. It's made everyone's life a bit harder, but has it made it better then becomes the question. And that's the transitional situation. So the costs are probably more significant than the benefits at this stage. It's distorting the market. You're going to see some market inefficiency was the expectation here. But in the long run, that's going to even out. So the benefits are a longer term, but we're going to have a lot of short-term distortion and trying to untangle what is the underlying operational performance of the company becomes a challenge in that situation. Next slide, please. So what about those non-GAAP metrics? And this is where we've created some more problems. So there is quite extensive use of these non-GAAP metrics. Earlier presenters today in our keynote talked about that. We saw this also in our work that we did presented to the forum a couple of years ago on the decision usefulness of financial statements. And so one of our investors was very concerned that this just allows more management spin as management can convince analysts to rely on pro forma numbers like an unaudited EBITDA number. That's my big fear, and we'll see what happens, he said. So as we start to play with the numbers, is it going to lead people to use some non-GAAP metrics that they can claim have more consistency over time, for example? in the short term, we've actually reduced usefulness in some respects because we've lost that comparability, and other impacts here. So EBITDA is a proxy for cash flow relative to liabilities, a classic rule of thumb, and suddenly both the numerator and the denominator have just become less useful or changed. And so we're seeing in these non-GAAP metrics and the heuristics, the rules of thumb that are used in valuation models start to get distorted, and people have to reinvent their models around what these numbers are doing. And it's particularly an issue with the non-GAAP metrics because they're not regulated to the same extent, and that's something we'll get to. And what's the cost-benefit trade-off? It's really a transitional thing. Everyone's grappling with it now, but after a couple of years, they're going to get the benefits and will come up with a solution to the EBITDA problem, as someone says. So I think there is a lot of costs in transition that are really significant, that will create noise in the marketplace. It means valuation models need to be adjusted. The reliance on some of these non-GAAP metrics and the interpretation of those non-GAAP metrics has to change. But over time, the market will sort that out. The question is, what are the costs in that transition time, and are the longer term benefits worthwhile? And we're also seeing some real effects coming through as more leases for entities that consider EBITDA to be a key metric because of how it impacts their performance. So it does again have impacts on the way the business operates and does create problems for investors very much in that transition stage. But there will be longer term consequences, but longer term the benefits should last out. Next slide, please. So coming to the end, what are our key findings and implications looking at AASB 16, both from a preparer and investor side? From the preparer side, data systems problems are a big challenge in implementation. As I said, we saw similar things when we looked at what was going on with the implementation of AASB 15. So this is something that I think standard setters really need to pay attention to. And it means that they're going to have real effects for the standards as well, because they're improving the underlying data quality by requiring things to be disclosed or recognised appropriately. The issue of recognition versus disclosure, I think, is something we really need to think a lot more deeply about. Recognition appears to lead to greater management and auditor retention. So we were getting the sense both from investors and preparers that the numbers that were being recognised are going to be much higher quality than something that I might just than information I might just disclose. And so the recognition isn't just about changing what the balance sheet looks like. It actually changes the quality of the information by the act of recognition. So brings into question appropriately adjusting based on unrecognised lease disclosures. The old capitalisation of operating leases is problematic if the disclosed information is of itself of a lower quality. And so we're actually potentially improving the quality of information in the market, because if you remember, a lot of our preparers were saying they didn't have the data and the data gathering was a big effort. So they're going to end up with much better quality of information as well. And we saw evidence that recognition leads to greater management and audit retention. So the quality of the number that's then produced is there, and the data and information that's there. There are transaction costs, and those transaction costs are for both preparers and investors. Comparability and usefulness may be harmed in the short term for investors. Preparers have a lot of transitions costs, obviously, in building the systems and the data to deal with that. This has been, I know, a hot topic, the AASB, for a while, and I've been talking about this, the issue of non-GAAP measures and how much we regulate non-GAAP measures. And I think one of the things that this highlights is that, in a quote from one of our investors, the number that is most impacted is the number that is actually not defined, which is EBITDA. And so to the extent that the market is relying on non-GAAP measures and pro forma measures that management have more control over, that creates problems, because it allows them to reinterpret and change what the impact is, and can really harm comparability. Now, is that a problem of investors for over-relying on those non-GAAP measures and following management, or is it a problem for regulators to then think about how we do that? I think it's a bit of both, and we've just got to be careful because some of those non-GAAP measures are going to be very industry specific, and they're probably not a space we want to see regulated. But the non-industry specific non-GAAP measures like EBITDA are things that probably need a little bit more regulation around them and clearer definition, so they're less subject to management playing with over time. And I think one of the most interesting conclusions we've seen here is standards have real effects. So it's not just about changing what's reporting and enhancing the quality of disclosure. It actually changes the management of the business, because we saw a lot of reporting of better management of leases as a result of having to implement the standard, as well as changing contractual arrangements, in part because of impacts on those key metrics, but it's leading to changes in the business. So it has those real effects, and we need to be very conscious as we put standards out what those real effects are. Some of those real effects could be costly. Some of those real effects could be really good benefits in the way we think things. So enhancing better management of leases is obviously a real bonus benefit for the standards, and I don't think that's something that standard setters have in general thought about enough, because they're focused on providing information to the capital markets. But the better management of leases in this case, and I think this is true, we saw better management of sales contracts come out of what was happening with AASB 15 as well. So those real effects are quite significant. And next slide, and we're done. So if you want to know more details about what we did, there are 2 reports that we've produced that CPA Australia have published, one on the implementation and preparers view, one on the investors view, and there's some links there, and you can get them by searching on Google, or we're happy to take emails, but I'll leave it open to the panel and questions now. Thank you.
Great, thanks, Michael. So making up this session for today's panel, we have Doug Niven from the Australian Securities and Investments Commission. So Doug is ASIC's Chief Accountant. He's responsible for ASIC's strategy and policy of financial reporting and audit and complex technical accounting and audit matters. He's a member of the IASCO Committee on Accounting, Audit and Disclosure and the International Forum of Independent Audit Regulators. Doug represents ASIC externally on financial reporting, auditing policy and technical issues. Doug joined ASIC as Deputy Chief Accountant in 1998 and was ASIC's Senior Executive Leader of Financial Reporting and Audit from 2008 to 2020. Doug also has more than 37 years of experience on financial reporting and audit. Second on the panel today, we have Tracy Carroll from the Department of Finance. So Tracy is the first Assistant Secretary of the Financial Analysis, Reporting and Management Division in the Department of Finance. Tracy is responsible for the preparation of the Australian Government Consolidated Financial Statements, monthly financial statements and budget estimates, development and implementation of Australian Government accounting policy, and cash and appropriations management. During the financial year ended 30 June 2020, Tracy oversaw the implementation of the Leases standard across 190 Australian Government entities and in the Australian Government Consolidated Financial Statements. Tracy is the chair of the Australian Government Portfolio Department CFO Forum and a leader of the accounting and financial management profession in the Australian Public Service. Prior to working in the Department of Finance, Tracy has held a number of senior executive roles across a range of Australian government entities, including the Department of Social Services and the Department of the Prime Minister and Cabinet. Third up, we have Adam Sopoulos from Wesfarmers. So Adam is the General Manager of Wesfarmers Group Accounting Function. He's a member of a number of public sector and not-for-profit boards, predominantly in the role as Treasurer. And last but not least, we have Lou Caporelli from UniSuper. So Lou joined UniSuper in July 2015 as Manager of Equities, covering a range of domestic and international stocks. He has over 26 years experience in equities and financial markets. In 2019, Lou was appointed Manager of Sustainable Portfolios and Governance with responsibility for UniSuper's environmental, social and governance approach. Prior to joining UniSuper, Lou was Head of Research at Evans & Partners, a boutique investment and advisory firm. Lou's previous roles include Director of Australian Equities with BlackRock Investment Management and Partner Senior Analyst at Goldman Sachs. He began his career in 1991 at Free Hills, where he qualified as a solicitor in 1992. And to facilitate today's session, we have AASB board member Paul Rogers, who is an audit partner at KPMG, who's over 19 years audit and accounting advisory experience in Australia and the UK. Paul specialises in auditing of real estate companies, including developers, contractors and investors. His clients range from large listed companies to smaller companies and investment funds. So I will hand it over to Paul now.
Thanks, Tom. So thank you for the introduction and welcome to the panel members. So we're going to have a range of topics to talk through this afternoon, and I think where we'll start is with the preparer's perspective. So I'd like to start with Adam, if I could. So Adam, you've been through your first year of AASB 16, and obviously you've probably been a key part of the West Farmers transition project. So I'd like to just understand a bit more about your experience as a preparer along the AASB 16 implementation journey, if I could.
Yep, thanks. Just checking everyone can hear me okay?
Yep, all good.
Thanks. Our experience varied over the course. Prior to the standard being set, we were part of consultation groups, and obviously saw that the standard change pretty considerably over that time. And that degree of change and uncertainty in the final standard meant that we couldn't be ahead of the curve in preparing. And we understood, for example, that some software companies stopped developing software to implement or to help account for the new standard just because the standard setters were doing U-turns every couple of years on what they were going to have in that final standard. And that put us behind the eight ball. And on top of that, we had a steep education piece that we needed to have internally and externally, where rules of thumb, like Michael mentioned, just couldn't be relied on. And that default position of, well, it'll sort itself out, wasn't going to be acceptable. So when we went through implementation, we found that there are a lot of intricacies to the new standard that we probably hadn't appreciated when it was being developed. We were looking very much high level. I mean, we all remember there was a period when there was two different lease accounting options being considered in the potential new standard. So we were looking at that high level, and it wasn't until we went into the detail of implementation that we found some intricacies and some assumptions we'd made about interpretation that were different company on company. And obviously we have an array of companies, and even internally there was big interpretation differences. Fair to say most of us were reconsidering our decision to become accountants, and architects were looking a more positive place to be.
Excellent. Great. Okay. So it sounds like a varied journey. One of the things that I'd like to understand a bit more is about some of the benefits. So Michael earlier talked about some of the benefits that came through. So what are the things that you learned about the business from going through the process?
Yeah, so fair to say that us as accountants and our finance teams learned more about the business's leasing. So as Michael mentioned, there was a deeper appreciation of what we were entering into. We didn't have the issue where we didn't have a centralised log of leases that Michael mentioned in the previous one. So perhaps there wasn't that big benefit there for us. But us as accountants had a better appreciation of that detail. I don't think it changed, though, the commercial reality of what our leases were going to be. Our operations guys always understood the detail of their leases and what they were entering into. Maybe the nuances in terms of allocating costs between services and the underlying asset may have changed. But overall, the substance, the economic substance of what we're going to enter into for leases, especially for a lot of assets that can't actually be purchased outright, was never going to change. But a deeper understanding of our lease arrangements from our accountant's perspective was a key benefit.
Okay. And thinking about feedback for the standard setters in terms of some of the challenges, have you got any thoughts or words of wisdom on that front?
Yeah. It took them 7 years to develop this standard from when it was first mentioned. And during that time, they took a couple of U-turns. Then they gave us 3 years to implement. That was to develop systems, develop processes, implement quality control, teach and learn. That's unfair. 7 to 3. And in that time, they had a couple of U-turns. So give us a little bit more lead time. I take Michael's point totally on board, though, that if you do extend it, then you'll just take up that slack. But if you had given us 10 years, we could have gone back and qualified as an architect and changed our career. So maybe a little bit more of a lead time. I do appreciate, though, that there were a number of practical expedients. So in terms of what they did to enable a more rapid transition, those practical expedients that were offered in the standard were good. And the level of disclosure that was required around the standard pre-transition that was mandated meant that we were able to nut out those differences in interpretations between firms before it started impacting our financials. So I think that was a good step too. I do think we need to go back, though, to one of the original principles was comparability. And the question's already been asked by David Lee. how can you comment on IFRS 16 versus US GAAP? I mean, that comparability, we're an international company, so we're in international markets, and now we've got a big set of companies over in the US that don't apply this lease standard and apply something completely different. Means that comparability is gone. So don't lose sight of what the original principle was. And if they weren't able to align, maybe they both need to go back to the drawing board. But hey, it's done now. Looking forward to the next one.
Thanks, Adam. Thanks. Appreciate your comments and your thoughts there. So we might change tack and thinking about comparability is probably something that our next speaker on the panel, Lou, will maybe have some thoughts on. So Lou, obviously as a user of financial statements, the whole point of AASB 16 really was to help you understand the results and position of companies. But the research that Michael and his team sort of come up with a mixed view in terms of whether it was positive or negative or ambivalent. So what's your experience? What's your views on whether you find it useful or how do you feel about it?
Sure, I would say I don't want to say I was ambivalent to it, and I do think it is on the whole broadly positive, but I wouldn't want to overstate. And maybe this is why, despite studying accounting, I never became an accountant, because I've never thought that the measuring of company performance was all that, significant in the actual company performance itself. Mm. And I guess it's good now to have a level of precision on things that we didn't have previously. But it would have been no surprise to investors that aviation and retail were the two sort of sectors and industries most impacted by the change. But it really was only a change in presentation, really, and better disclosure helped. But it isn't like analysts in the retail or aviation sector were previously unaware of the level of the reliance on leasing, and therefore the indebtedness of those companies when it wasn't previously sort of explicitly stated in the way that it is now. So by way of a simple example, when I was at uni 150 years ago with Michael's predecessors, they taught us about looking at metrics for gearing and debt serviceability, and the main one was net interest expense. But that was because in the olden days when I was at uni, we used to have things like interest rates. And so net interest cover was a reasonable measure of looking at a company's ability to service its debt. In a world where net interest cover, where interest expense or interest rates are zero, the net interest cover is a meaningless measure for debt serviceability, because every company likes to brag about how strong their net interest cover is. Mm. But adjusting for that, I'm no aviation analyst, but I am a retail analyst. And the first thing we would look at is not net interest cover, but fixed charges cover, which was essentially incorporating the impact of the leases on the sort of financial structure of the company. And so that meant that we were doing it. But I'll be the first to admit that it was a reasonably crude way of looking at it, where you simply add back the entire rental expense. The way that the standard now tries to incorporate it by converting it into essentially a principal and interest loan equivalent means that you've got a greater level of precision. But even then, I wouldn't want to overstate it, because you can't create an equivalence for a lease in the same way that you would for a loan. For example, I don't know that the lessor has the capacity to call in the lease in the way that a bank has the ability to call in a loan. And there may be nuances there, but my point is that they are different, and we're attempting to sort of put the square peg of a lease into the round hole of a loan, and that has merit. One of the things that I do think that has been very useful in this exercise has been to, I guess, disabuse people of the notion of the outstanding returns that some retail businesses make, because these, when you think about supermarkets, Woolies has 1,000 supermarkets, and until this lease standard, they had no, they never appeared on the balance sheet. And so it looked like Woolworths make a fabulous return. They actually do make a fabulous return in their supermarkets business, as does Coles, but it's nowhere near as good as the return that they now show, because you've actually got the full asset base incorporated in the financial statements, and so you do get a more realistic sense of what is the genuine return on that those assets generate. The other thing I wanted to raise, and I suspect some of those comments that Michael had in his slideshow sounded suspiciously like what I might have said in the surveys, but one of the things that where comparability is affected is in relation to the change that it has on metrics like EBIT and EBITDA. And I think Michael mentioned that both the numerator and the denominator are affected. And what that does is that any sort of historical analysis is now sort of thrown out the window because of this massive break in the series that has occurred. And I'm sure sort of sell-side analysts in particular will get their knickers in a twist over this, because they've spent years lovingly preparing these time series and now they're almost redundant. And that is unfortunate, but I guess that is the price of progress. The bigger one I also focus on, particularly in the sort of retail and supermarket sector, is the change that it's caused to EBIT and EBITDA margins. And so now you don't really know what is a good EBIT or EBITDA margin relative to other situations. But it is helpful. And, one of the other examples I'll give where this is a real issue within a company is that Ramsay Healthcare, as an example, introduced a metric called EBITDA. So you add back the rent expense. And the reason they did that is to assist comparability within the company itself, because they had hospitals in Australia which were largely owned, but their hospitals that they owned in the UK were largely leased. And so to ensure a level of comparability within the company itself, they moved to that EBITDA metric. And so this, I guess, somewhat levels the playing field, the accounting standard. So while it's been painful, I guess it was something whose time had to come. And, we're the ones who have the misfortune of having to deal with it in this generation of investors and preparers to do that.
Excellent. Thanks, Lee. That was very insightful and comprehensive as well. So we might move on to the regulator perspective. So I'd like to welcome Doug. So Doug, as a regulator, I think we probably take it for granted that new accounting standards are a focus of yours and your organisations. So what I'd like to explore to you is some of the things that might be on preparers and auditors' minds right now. So, what are the things that ASIC have done in response to the adoption of AASB 16?
Thanks, Paul. And you're right. A new standard, particularly one such as the Leases standard, has been of attention to us, and we've made it a focus area for directors, preparers and auditors. And interesting enough, going right back to 2016, I had to remind myself of the date, but it was actually December 16 that we put out a release saying, you got three new accounting standards coming. Biggest changes since IFRS. The third one was, of course, the Leases standard, applying for those years commencing 1st of January 19 onwards. And so not dissimilar to the adoption of IFRS, we highlighted the importance of focusing on the systems, the processes, looking at the transactions, also disclosure to market, quite importantly, in the lead up to the adoption of the standard, both through the notes, the financials, continuous disclosure, and as well transaction documents if they were raising funds. So when we're talking about non-IFRS information, which I'm sure we'll come back to, and what was happening and what Disconnect was calling, particularly for lessees, is information that should have already been available in the market and subject of demand by investor groups as well. Now, interesting enough, the timing of the standard, when you think about 30 June year ends, was quite interesting because it tended to coincide with something called COVID-19. And so if you've got a June year end, listed, first time it hit was a half years for 31 December 19, and then the full years 30 June 20. So when we came out with our focus areas, both through some frequently asked questions and then a media release around the 30 June reporting, we obviously had a big focus on COVID-19, what it's doing to asset values, all the disclosures around that. But we did also, amongst all the other things we could have mentioned, included the lease accounting standard for obvious reasons. And so we have been having a look at what has been happening there. Of course, December balance dates, it hit 6 months earlier, by the way. But all of the issues that might arise there, what it does mean to the market, and what messages we might give. So as well as putting our focus areas ahead of 30 June reporting, we will shortly be putting out our findings for that period. And also in the next week or two, we'll be putting out our audit inspection report, which reinforces the focuses for auditors that are actually already there in our frequently asked questions as well.
Mm-hmm. So without mentioning any names, are there any findings or key themes that you're seeing? Obviously, they don't want to preempt the release of the report, but anything that you've kind of seen is a common thing?
Yeah, definitely. So there are a few common themes. One was, well, actually, I might cover the first one a little bit differently. Rent concessions with COVID-19, obviously that can have an impact for lessors and lessees. So we did actually give some guidance in a frequently asked question leading into the 30 June reporting season. And we will give a reminder about lessee accounting and an updated frequently asked question leading into 31 December. But we always thought the impact was probably bigger for lessors than for lessees, because some of the major lessees weren't getting concessions. But impairment was the interesting one. And look, thankfully, most preparers, and this is on the lessee side, by the way, most preparers and auditors have been aware of this issue, but it can actually substantially affect the numbers. Everyone assumes, well, it's just an accounting standard. Why should we end up with different impairment? But of course, now you've got these right of use assets you didn't have before. It's affecting the cash flows that go into it, because we've been talking about EBIT and EBITDA, which is from the starting point for the cash flows, and can affect in discount cash flow, the discount rate based on, say, weighted average cost of capital. So there's a few variables at play there, and yes, you can come up with different answers. One which was a little bit unusual, and I understand exactly why the standard setters came to where they did, is a lot of discussion around, well, is this right of use asset for lessees a tangible asset, an intangible asset, or sometimes tangible, sometimes intangible? And that's an issue for a whole lot of things, lending covenants, financial condition requirements, and we have put out something on that, actually no action position in relation to AFS licensee financial conditions. I won't go into the detail of that. And there are some other odd ones we've come across. We're just having a look at some debate around the transition and what it meant for the numbers for things like rent-free periods for leases and so forth. And another one that's come up and it's really detailed is accounting for leases which have variable amounts, and can you actually have a zero value lease? And what does that mean for people? So they're all very interesting issues, and I'm sure we'll talk more about non-IFRS financial information, but you can probably guess our answer has been, don't do it in the financial statements. We'll put aside segment reporting for the moment and make sure it's not misleading outside the financials, consistent, comparable, explained and reconciled and so forth. I know the AASB is looking at that one.
Okay. And just as a final comment, Doug, in terms of obviously we've had 3 new accounting standards come out in quick succession. There might be more coming forward, and I'm thinking about the AASB's projects on primary financial statements and things like that. What advice would you give to entities in preparing for the implementation of that? What are the things that are on your mind?
Yeah, start preparing early, because the adoption date, even if you're not adopting early, comes really quickly. So we've actually just in the last couple of weeks put out one on the new insurance standard. That probably doesn't affect as many companies as some of these other standards, but you need to look at the systems processes really early. It can take time, have proper implementation plans, properly monitored and so forth. And the other problem is, while people do tend to focus on the impact, recognition, measurement, what it means to net assets, profits and so forth, they often forget there's a whole lot of new disclosure requirements, and that they don't think about that until it's sometimes after the first balance date, and then they're scrambling and thinking, oh, okay, now where do we get the numbers from? So definitely planning in advance is probably the best message I can give there.
Awesome. Thank you, Dub. Thank you. So we might move now to Tracy. So Tracy, your experience is public sector. I know we've touched quite a lot on the private sector things, and I think what would be useful for us to understand is some of the themes that we've talked through today common to the public sector as well?
Yeah, thank you, Paul. Yeah, absolutely. I would say that there's a lot of commonality in things that sound very familiar from a public sector perspective, and then there are some particular nuances that are a bit different in the public sector. Absolutely, those issues in relation to systems, very common that there wasn't, a system that was readily able to be picked up and used. And across the public sector, it is such a diverse organisation, so it's easy to say government, but national museums versus defence forces, and there's a whole range of size and scope of the work that's being done. And so in that space, there are entities that have tens of thousands of leases, and then there are entities that have only one or two. So the same issue in relation to identification of leases and capturing of data was a challenge, and particularly in some spaces that there are unusual circumstances that I'm sure there are unusual circumstances in many private sector entities, but for public sector, things like at airports, the fact that customs needs to be at the airport, there may not be a formal lease agreement, there may not be a payment, but there is a legal obligation that happen. And so there's a whole range of things to work through in that space. I think it's been pointed out a few times this morning about the benefit of people probably understanding lease arrangements. Having our property teams work more closely with our finance teams is absolutely a benefit, but there has needed to be a bit of a skills uplift in a few spaces. Particularly challenging has been needing to explain why an accounting standard change will have a significant impact on the budget aggregates when government's very focused on things like, are we returning to surplus? What does that do to underlying cash or fiscal balance? What does it mean for net debt? And so that's been challenging to explain that through to parliamentarians. However, the impact of COVID-19 has certainly changed the conversation there, and people are focused on different matters. A few people have pointed out this morning the issue in relation to comparability, and so in the public sector, when there are accounting standard changes or where there are changes that do impact on budget aggregates for each of the budget publications, if I'm not sure if many people here would be aware, but at the back of that there are historical time series data, so we go through a process, the government goes through a process of backcasting the historical data, and so that assists to ensure that there isn't that loss of comparability. And then the other, just in terms of a practical sense, of one of the things that we particularly had to look at in terms of public sector is the way government entities are funded. They're funded on their cash basis as their requirements are, and there's a shift or a difference in funding in terms of operating funding needs versus capital funding needs. And so if leases are being treated as assets on financial statements, that needed to have a little bit of a shift in terms of the way that we are managing that funding. So, so very, very similar, but some public sector specific nuances there.
And we seem to have lost Paul there.
Yeah.
Hopefully he'll be with us in a moment.
So it's Mark Shying here. Got some advice that we've lost Paul for the moment. So I think, just looking at the time, and yes, thanks Tracy for that. Speaking from a public sector perspective, and interesting to hear the commonality in views, but also the what would you say, the special intricacies of the public sector also identified there. So looking at the time, I think we can push ahead perhaps with the Q&A session. So I will just have a look at this Q&A and then start to pose the questions that have come forward.
Can I ask a question of Tracy?
So sorry, Paul, we just lost you there for a short while, but we were going to now go ahead to the Q&A.
Yeah, that's fine. Sorry, everybody froze, and sorry, apologies, Tracy, and the rest of the audience. I was listening, but then it just froze. And so let's move to Q&A. Just like to thank all the panel for their comments first of all before we move to that section. Some really good insights there, and I think hopefully appreciated by our listeners and viewers today.
Thank you, Paul. So the first question here is, what is the Australian Tax Office's position on AASB 16? So I'm not too sure if there's anybody here who would like to start with that, but perhaps Adam, coming from a preparer's perspective, you might have something on some view there.
I don't actually understand what their position is. I do know that it hasn't changed. So we've got a deferred tax asset and deferred tax liability for the difference between the accounting side and the tax side. They've gone with what we previously had, which was you get to deduct it when you actually pay it. So that difference, the accrual versus cash difference, is another deferred tax asset and liability. I'm not sure if there's any intention to change it, especially with the amount of subjectivity that's involved with implementing or applying the new standard versus a typical cash arrangement, which is obviously very easy to track. But I see Mark's happy to, if you're happy with that response, I'm happy to share it around if other people have a different view. Michael?
No comment on that one. I'm not across what the ATO is doing yet.
Okay. Anybody else there who would like to make a contribution or to that particular question, has a view?
I think what Adam's just said there, I think a lot of companies have got the same position from what I've seen is deferred tax balances sat there relating to right of use and the lease liability. So that would be consistent to what I've seen.
Okay. All right then. Thank you. So actually something that Adam did mention in his part of the response was relating to the practical expedience. And so the question I have here would be to Michael, whether practical expedience was raised in anywhere in that 20,000 words of transcript that you've got. And if so, can you share anything with us about that?
Nothing from the investor side in terms of the practical expedience, and in terms of the preparers in the practical expedience of the implementation. We did have 30% who were taking advantage of the low value and short-term lease aspects of the exemptions, but we didn't have a lot of detail about any issues coming up in terms of the shortcuts. The one thing some of the investors did say to us was that they were using the transitional disclosures so that they didn't have to change their valuation models because they could still get all the old information. And so that was made it easier for them not to yet have to update everything that they were doing, so they could still keep doing things, at least in the short term, the same way as they've done it in the past. But that gives them a little bit more time in terms of when they have to adjust their models. But I think that was more a bit of inertia than anything else.
Okay, thank you. Adam, would you perhaps like to say something a little bit further about the practical experience from that preparer perspective?
We did see a very so we were trying to compare the way that we were implementing and the practical expedience we were applying against others. One where we probably differed was the application of that small value threshold. We didn't go with the 5,000 US. We had the benefit of materiality, and we made a call that was going to be a lot higher threshold for us. And that's because we've obviously got billions of property leases versus maybe $100 million worth of equipment leases, and the number of equipment leases would have been tens of thousands. So I'm not sure whether or not it was appropriate for the standard setters to implement a $5,000 US threshold when, one, the standard isn't actually in US, anyway. And secondly, to apply that across the board, $5,000 could be material to some organisations, and it's totally irrelevant to others. So I did appreciate the fact that there was practical expedience in there, though. Shows some connection to reality from the standard setters, which was good.
Thank you. Lou, as a user, did you have any view on the practical expedients that were being used by preparers?
That's probably a level of nuance that I wouldn't have paid attention to in terms of, you know, where the numbers landed. It did chat. Like, the one thing I'll say in terms of where the numbers landed, while it moved EBITDA particularly and EBITDA to some extent, getting it down to the NPAT effect and EPS, it broadly it was in some cases it was a few percent more, in some cases it was a few percent less. I think the investor community was probably a bit lazy in relying on the sort of pre-AASB 16 regime in terms of looking at, you know, what was the change year on year, and it gave the analysts a bit more time to sort of change their models. But that practical expedience thing, I'm not entirely sure what that actually means, and I'm pretty sure it wouldn't have been, even if we did know what it means, whether it would have had any impact in the way we look at things.
Thank you. There's a question here for Michael, just relating to the research. So the focus there was on listed or limited to listed entities?
It wasn't exclusively listed entities, but the predominance was listed entities, yeah.
Okay. Was there any not-for-profits in there? Because there's a question about right of use assets in the not-for-profit sector.
No, we didn't do that. I mean, I have some first-hand knowledge of what goes on in the not-for-profit because I'm on the board of a fairly sizable not-for-profit. And it's interesting because sort of the view of a lot of people there is, why the hell are we having to do this? And certainly the view of the CEO was, I don't see how this makes any sense for us. So it's interesting, and I'm not sure, and I know this is something you've been working on, Mark, that donors pay a lot of attention to what's going on in financial statements for not-for-profits either.
Okay, thank you. Now, a question here was, sorry, I'm just trying to read this. Okay, so this question here was about if the substance before and after capitalisation doesn't change, unless there are real effects changing the leases undertaken. But if preparers are saying their identification of leases has been an issue, how could the estimates of the effects of leases pre the standard have been of a quality that matched the quality post implementation? So I suppose this is a preparer question. So perhaps I'll head back to Adam in the first instance.
Sure. Thanks for the question, Kevin. Good to talk to you again. So it's fair to say that the information pre and post for us was very similar. We had systems in place beforehand, but I appreciate where the question is coming from, which was a comment that Michael made in his presentation, where some of that information wasn't handled beforehand by certain preparers. What we did find, though, was the way that it was interpreted under the new standard was very, very different to the way that we'd interpreted it commercially, operationally. And if you take, for example, option periods, and there's another question there about it, the way that you interpret an option period and whether or not it's going to be exercised, or the certainty around exercise is very much for one's judgment. And it's really difficult to disclose all of those judgments across 5,000 leases that are individually maybe immaterial, but collectively very material. So there becomes that issue about how much quality can be in information that is so aggregated, short of putting in 40 more pages worth of lease information in our financial statements. But Michael?
Yeah, I think you're probably an exception in having the data in the right place, and that's because of the size and criticality of the leases in your sector. But if you look at the two things that came out in the survey that I think were very telling here was, one, the amount of effort that was going into identifying leases, and the issue of having the data and available systems, and that's sort of where this comes from. And I think it just highlights that when something is getting recognised, it leads to a lot more attention from management and auditors in what that aggregated number ends up looking like, because it has a bigger effect on the financial statements overall. And so that creates it does create a quality of information problem. It shouldn't have made as much difference in theory as what it has, but I think that was, to me, one of the learnings here, that when we start to require recognition, we're actually going to change the level of attention it gets, and so the quality of the information that will be reported will be building on better data. But I absolutely think you're right here. One of the biggest problems when we start to get to that recognition story is that decision about how we're aggregating everything, and aggregating so much that then the end resulting number becomes unable to be interpreted because of all the individual underlying assumptions and judgments that have gone into it. And I think there's a real debate around this issue of recognition versus disclosure, and who's in the better position to make requisite judgments, the investor or the preparer, in looking at that. And that's something that's certainly a future area that we're looking at in terms of research, in trying to understand that debate between recognition and disclosure. But one of the things that came out here is this quality of the underlying data is better when there's a recognition requirement versus a disclosure requirement, which is a little scary.
Thanks, Michael. Perhaps if I could ask Doug just to a view there on that.
Yeah, I don't doubt what Michael says, but one of the things that does come to mind is because of the focus on the new standard and people going back and looking at the documents, that in itself can make a difference. And so if I draw an analogy, and I won't go too far into this, but the revenue standard, what we actually found was when people had a look at their contracts again, well, they think, okay, we've got to change the accounting under the new standard, but by the way, we actually had it wrong under the old standard as well. I don't know how you measure that, by the way, but there's an element of that in it as well, that people became comfortable with their accounting treatment, assumed things had changed from period to period, and when you re-examine things, afresh, that can make a difference. So I suspect with the Leases standard, there may be an element of that in there as well.
Thanks, Doug. Tracy, I know that you said, well, given COVID-19, parliamentarians' focus is on, related to that and the budget, etc. for that. But if we put COVID-19 aside and you had, been tasked with the explanation in terms of this accounting standards change and the effect on budget, how would that have played out?
So we put a lot of effort into, actually, as we were putting out monthly financial statements, and we started in terms of budget last year as well, describing that this accounting standard change was happening, and that it was going to have a material impact on budget aggregates. And so it wasn't until MyEFA last year when we started to recognise it and actually put the information into the financial statement. So, for ministers directly involved in terms of financial statements, so the finance minister and for the treasurer and prime minister, there's a lot of information that's being shared and it's able to be explained. Had it not been for COVID and there had been a significant movement in, say, net debt driven by the implementation of leases, I anticipate that more parliamentary committees or more public sector commentators might have looked into what has happened here. I think it helped in terms of our explanation, though, is there was a lot of media and a lot of public commentary in relation to the experience in private sector too. So we're not kind of out on our own explaining this. But it was really hard for government when they're trying, position this time last year, really trying to return to a budget surplus and trying to control net debt. And then we introduced an accounting standard change, which steps them back quite a bit.
Thanks, Tracy. Perhaps we could just turn to another question now. So I've got a question here about, I would have thought EBITDA was fairly well defined and an accepted measure. So perhaps if I could go to Lou on that.
EBITDA is well defined in the sense that there's many and varying definitions of it, but it's not well defined in the sense of being universally accepted as a single definition of it. And it's essentially made up by companies to give whatever result they want. Because when the reference to EBITDA, I think if you look at statutory accounts, you can calculate a statutory version, I guess, of EBITDA, but the EBITDA measure that companies want to use is their version of underlying EBITDA, and that's where all the bad things that have happened get ignored, so that you end up with a higher level of earnings in that EBITDA measure. And it's, you know, I think Martin Lawrence made reference to EBITDA as a proxy for cash flow, and it's basically an attempt by the management of companies to essentially bamboozle investors into thinking that the level of earnings is so much higher than it really is. So from that perspective, it is a bit of a polluted metric, and with the AASB 16 changes, that's just added another layer, not so much of complexity, but just an additional layer of distortion to that measure. And that's why, you know, EBITDA is always seen as the holy grail. Any IPO document that you look at is going to be full of terms like EBITDA, and an even better one, pro forma EBITDA, which means really made up in terms of what you want it to be and what valuation the promoters of that IPO are trying to get to. So yeah, it is definitely not a defined measure, and I'm aware of other projects that the ASB or IFRS are working on, and they're trying to run away as fast as they can from any any expectation that they will ever define it.
Thanks, Lou, for sharing with us your code book. That's been helpful. Michael, there's a question a statement was that it's probably easier to take leases out rather than adding them in. So because AASB 16 requires them to be added in, therefore it's a winner. Is that something that your research could be summed up as saying, or did you find something different from that?
Look, I think I'd agree it's a winner, but I think that misses a lot of the other issues that are going on. The impact, as we've talked about, on information quality, the potential for better management of leases that also comes in, and some of the other real effects of what's going on that I think are really important to recognise, that standard setting is not just about creating a better measure. They actually have real effects and changes what the business is doing, and as a result of that, that can often be the bigger impact in the longer term. And so it's not just whether it's in or out and what's computationally easier. I think it's understanding the way in which we're reacting both internally and externally to that new information.
Thank you. Now I have a question here about options, and where's that gone? Yes, example in terms of lease terms, so option renewals, and that there's a great deal of diversity on how lease terms option renewals are assessed. For example, in the retail industry, those with shopping centre leases, distribution centres, etc. It seems some are taking a very narrow view of recognising renewals. Essentially, they are not being included. Others are including extensions. This can be a significant difference with a 5 and 10 year extension for property leases. And then we've talked about comparability along the way. And so therefore, what does that actually mean in terms for comparability or enhancing comparability? So Adam, you might be a good person to start with on that question.
absolutely massive divergence. We have obviously industry groups that talk about those types of things as well. But what's amazing is that it stayed in the standard, notwithstanding all of the uncertainty that is more prevalent now than ever before. And so the interpretation of that should even get narrower, in my mind. I mean, who would have thought that 9 months ago we would only have, 3 or 4 flights every day coming out of, in Perth. And yet we're talking about potential airlines who have renewed for tens of years, or options over the last tens of years, every single time. So, and more so even with retail, when we have lockdowns, why be so certain that suddenly you'd want to renew that lease on a shopping centre, because there may not be access for the next 2 years, depending on where things go. So I totally understand the issue that comparability makes it difficult, that there's so much judgment involved in it. And it's not just judgment in a point in time, but then judgment and comparability year on year, when you've got so many things changing in the macroeconomic environment. That could affect this materially. So it sucks.
Lou, perhaps if I could just throw to you on, do you have a response to that question there in terms of the options?
Yeah, I guess if you're in the staples sector with supermarkets and you enter into a lease, so the reality is you may enter into an initial term of 5 or 10 years, but you're probably going to be there for 30 or 50 years. I mean, think of the supermarkets that we all frequent. I'll bet they've been there for 30 plus years in most cases. Where it becomes a bit more difficult is if you're, say, someone like a JB Hi-Fi, and you've generally got around about 200 stores around the country, and from time to time, you're always going to be looking at that, bottom end of the tail and looking at, what you might do. In some cases, JB's, you would think, I mean, just from my own experience, you seem to walk past the JB's every couple of kilometres. Wonder, does that really make sense? And that's half the time because they're probably experimenting themselves about where the best site is. So in those situations, it might be a little more difficult to have a level of certainty in relation to the any option you might be given. But I think companies are, one of the things coming out of COVID, I would also say, is that companies are going to be far, far more, strategic in their thinking around leases. And Adam's employer, Wesfarmers, I'm sure, is thinking long and hard about all of its Target and Kmarts, particularly when you factor in that they now own Catch.com, that, I'm sure their, willingness to enter into long-dated leases, with multiple option terms is probably changing as we speak.
Thanks, Lou. Now, there's a question here that actually was, part of the question was, are banks of SMEs using AASB 16 inclusive or exclusive information? I don't know, Michael, in terms of your research, whether you were speaking to any bankers and perhaps whether there's any push down of AASB 16 to, I'm going to say to borrowers.
No, we didn't speak to any bankers. We were only looking at the investor side, not to lenders, to see what the situation. And part of that was that, at the time we were doing this, there wasn't a lot of information out. We were still in the early stages of the reporting cycles. So I expect that will be something that'll be interesting to see where that happens, because your banker has a lot more influence sometimes in being able to directly demand that they get what they want, and to see how they respond to it will be an interesting situation.
Okay. I don't know if anybody else there has anything to share on that question. No, that's okay. Now, the next question I have here was, and I didn't know what this was, PPSA, but I've looked it up and I can see that it's personal property security. So it's actually in the hire. It's in the hire area. So the example was hire-as equipment, which can be on short-term to long-term leases. So the question there was, Now, trying to find out where it's gone. Where has it gone? Have the recent reforms of PPSA leases affected the disclosures and classifications, or disclosures? I would think. Any experience? I don't know if Wesfarmers got a hiring part of their organisation. I suppose if Bunnings does.
Yeah, that's all subcontracted. So I've got nothing for you on that. Sorry, Mark.
Okay, thank you,
Mark. I'm just guessing. I mean, it would have to extend over a year, I guess, for it to be something that would get capitalised. But you know, there's far better people qualified than me to go into the intricacies of AASB 16. But just at a principles level, I would have thought that's that would cut out a lot of the higher equipment type arrangements.
Yes, I'll have to understand more about PPSA and what are the types of transactions there, but that's a fair point. This question is directed to Michael. Capitalising leases is more complex than treating them as operating leases. Did any of the participants comment on changes in required staffing as a result of the new standard?
Yeah, so one of the things we did survey about was what were the project resources you had in your implementation project. And we'd asked the similar question on the previous work we did around AASB 15. What was interesting here is more than 50% were relying on existing internal resources, and it was only about 20% were looking for new staff hires to make the implementation project team happen. And part of what we think there is that people have already expanded their teams with the implementation of 15. And so there's probably some reuse of staff and redeployment of staff now. 15 implementation wind down to then start on the 16 implementation. Similar sort of thing in terms of other resources like consultants and auditors and other contractors. So that was down around low 20% of respondents doing that. So a lot of it was done by internal staff, and I think it was building off the existing staff they had built up around the 15 implementation and held some of those over through to the 16 implementation and redeployed.
Thank you. Thank you. Now, a question here is around lease liabilities, about remeasurement of lease liabilities, where there are variable lease payments, particularly where they are indexed to consumer price index, although consumer price index is probably pretty low. But anyway, whether there are any challenges there with the lease liability. So I'll just throw that open to whomever would like to provide an answer to that question. Anybody have a view?
Echo the question's comment, which is I think implied assumption that there was and there are challenges with that. There are some public benchmarks available in different property guides about underlying lease components. But the remeasurement, the continual remeasurement of those is difficult. And where those changes, where those prices are so generic that their allocation across portfolio of leases might be okay, but where you've got only one or two leases in particular areas, the cost that these benchmarks might pull out could be considerably different to what's actually being incurred or what you're incurring. And what makes it even more confusing is you've got very different types of leases. You've got what we call net leases and gross leases, etc., where these are captured and not captured. And so the recording of those leases, even though it might be for a very similar property across the road from each other, becomes a little bit different. And there is some option there is an allowance in the standard that allows you just to assume the entire gross amount is related to the asset. So you could have examples where the same lease terms, just one being gross and one being net, results in double the lease liability. It again goes to what I think we've said from the beginning, which is the comparability hasn't necessarily improved between companies. You do have a better insight to the company's lease portfolio and the size of the price, or the size of the liability at least. But yeah, there's a lot of devil in the detail that makes these calculations really tough to do, and then really tough to understand and communicate to your users.
Okay, Thanks, Adam. Tracy, in the public sector, is this an issue?
So yes, I would say it's a similar thing, and I think that so there's a difference too in terms of the borrowing rates, and so the incremental borrowing rate used to assess that, because the government rate is quite clearly lower than for private sector, and so similar leases, like Adam had talked about, that you will have a very different value of the recognition in the financial statements, and so the comparability, again, between public sector and private sector, you lose some of that. It does that naturally make sense? And I think that one of the other, in terms of talking about comparability for public sector, is the comparability between Australia's financial statements compared to international. And I think it's been referenced that there are many countries who are still yet to take up this accounting standard, and so you lose some of your international comparability. But there is also, for government accounting, is that there is a requirement through Australian Bureau of Statistics. They produce national accounts which are based on government financial statistics, which historically in relation to leases has been relatively consistent. Now we have a bit of a divergence, and so there is an issue in terms of comparability internationally in relation to accounting standards versus government financial statistics, and then whether the information that's required, because you would need to keep two sets of books to provide that same set of information, whether that information is available for that international comparison too. So a bit of a different spin on that question, but there are some comparability issues that have been introduced for public sector as well through this accounting standard change.
Yeah, okay. And it's interesting there that you're identifying that difference between your the statistical reporting and the financial reporting, and I suppose therefore the potential for the consequences in the from the ratings agency's perspective in terms of what feeds into that rating methodology.
So I think that there's an awareness in it in terms of though the Bureau of Statistics to be able to do their reporting and their work, how they actually capture and collect that information has become significantly more challenging for them of recent.
Yeah, thank you. Well, I believe that we've got to the end of our Q&A session. So I'd like to first thank Michael for his presentation, which is very well received and is evidenced by the questions that have been posed. And I particularly like the panel under the expert facilitation by Paul, and for us to be able to hear the thoughts of Doug, Tracy, Adam and Lou, and the different perspectives that they have brought. So thank you very, very much. And of course to the audience out there for the questions that they've put, and we've done our best to ask questions, but we could keep on talking for leases for a lot longer, but I think we need to go for lunch. That's right. So I'll now pass back to Tom. So thank you very much.
Thanks, Mark, and thanks to the session today. So we are going to break for lunch, and we'll return back at 2:15 Melbourne time. So it's about 58 minutes, and we'll come back for the final research team, which looks at are accounting standards understandable, and then followed by an update on the AASB by Antaka. So we'll return back at 2:15.